Hi, everybody, and want to add crypto to your retirement portfolio? Here's how and want to consider. With many cryptocurrencies surging last year as the overall market surpassed $3 trillion in value, a growing number of retirement savers are looking for a way to tap into the potential before joining the crowd. However, investors should get at least a basic understanding of the asset class, if not becoming expert themselves on the esoteric investments. For starters, investors will likely be on their own if they want to add cryptocurrencies to their investment mix as traditional individual retirement account and company sponsored 401k plans typically don't permit investing in crypto or other alternative assets. That leaves investors to dabble in digital currencies, in self-direct IRAs, or in taxable accounts. What's more, crypto's volatile like reward come with risk that can make it difficult for professional investors to stay in the green, let alone mom and pop investors. Digital currencies has been the best performing assets class in the world over the past 3 years, but it has also had multiple drawdowns of more than 50% during the time. The market is new and changing fast, says Matt Houhan, Chief Investment Officer at Bitwise Asset Management. Crypto investments can go to zero, and there is no guarantee that the largest and most important assets today will remain so in the future. Baron spoke with a number of investment pros for something to consider. Is it prudent to bet on crypto? A key argument for adding crypto to retirement saving is the diversification benefit of an asset class largely uncorrelated to traditional assets. Crypto is also touted by enthusiasts as an emerging asset class that maximizes returns relatively to the risk investors are taking. And by investing in a qualified retirement account, any gains will be tax deferred or tax free depending on the account style. David Ermeyer's Chief Investments Officer at 401k provided for us all believes investors have more to lose by not making digital assets part of their retirement plans. Choosing to not include cryptocurrency in a diversified long-term portfolio is a big bet, he says. It's a gamble that markets are inefficient and that large institutional investors fundamentally misunderstand the potential of blockchain technology. A small allocation to cryptocurrency in a diversified portfolio might be able to increase expected returns without materially increasing overall portfolio risk, he says. Indeed, a FTSE Russell simulation last year found that portfolios containing cryptocurrencies consistently outperformed those without cryptocurrencies and without meaningfully increasing risk. How can I fold crypto into my retirement plan? The easiest way to buy crypto in a retirement account is sought tax-free, self-directed IRS and solo 401k plans. Investors can choose from companies such as Bitcoin, iTrust Capital and IRA Financial, among several others that specialize in crypto-backed IRAs. Big financial firms like Fidelity and Vanguard don't allow individual investors to invest in crypto. Once your account is funded, you can trade digital assets inside your self-directed retirement account using the self-trading area of the platform. Then there are custodians such as IRA Financial that allow clients to invest in digital currencies directly via crypto exchange. Investors can use their retirement funds to buy all the major cryptocurrencies directly through a US-based exchange. The IRA holder has 100% control over the account and can trade anytime. Until recently, crypto investors was out of bonds for company-sponsored 401k plans that changed in July 2021 when Force.O partnered with Coinbase Global to allow workers in plans its administrator to invest up to 5% of their 401k contributions in Bitcoin, Ethereum, Litecoin, and other coins. While direct ownership can be an efficient way to gain exposure, Hugen solutions, it takes a lot of monitoring, management, and attention over time to manage those positions. For some professionally managed cryptocurrencies themed ETFs may be a better route to the crypto market, he says. How much should I allocate? Key factor determining the size of crypto allocation include one's age, level of wealth, and appetite for risk and volatility, says Adam Bergman, founder and CEO of IRA Financial Group, who holds about 5% of his retirement assets in crypto. He considers thought that may be a bit high for some individuals. Considering crypto's volatile nature, a little goes a long way. Most investors we work with have between 1% and 5% of their retirement portfolio in crypto, says Hugen. With allocation comes periodic rebalancing. Crypto allocation needs to be routinely tweaked to keep it aligned with investments, since it can have such outsized returns up and down. Rebalancing can be even more important in crypto than in other assets, says Hugen. And what coins should I choose? Crypto experts tend to favor blue chip coins, core established cryptocurrencies like Bitcoin and Ethereum, for instance, over upstarts. The selection of coins correlated to the level of risk investors are willing to assume. Bitcoin and Ethereum are the two largest cryptos and likely the least risky. However, they aren't immune from price swings. Bitcoin has gone from a peak of $65,000 to $31,000 in just a few months in late 2021 and early 2022. It was recently trading around $45,000. The level of volatility could be considerably higher in smaller, less established cryptocurrencies, yet some of the top performing assets in 2021 have been altcoins like Solana, which popped more than 9,000%, and Dogecoin, up about 3,000% compared with a 5.800% gain for Bitcoin for the same period. To the extent people are taking a long-term outlook in their retirement account, crypto could be a good fit, Hugen maintains. What are some other risks? As with many early-stage technologies, cryptocurrency faces unknowable and risks that make their prices volatile. The potential applications of blockchain technology from supply chain management to banking are undeniable, but the speed and extent of the technology adoption won't be known for years. There's also the risk of criminal activity, including theft and hacks. The short history of cryptocurrency is replete with the instance of cyber attacks leading to millions of dollars in losses. And the recent crackdown on crypto mining and trading in China and the outright ban in several countries show that regulation could be a significant source of risk. Still, the risk of cybercrime can be offset in retirement accounts by ensuring plan custodians and exchanges have necessary safeguards and regulatory approvals in place. Meanwhile, diversification can protect against volatility. Okay everyone, thank you for watching this video, please subscribe.